In the last 100 years, the US dollar has inflated 1,391%. For perspective, if you were somehow able to buy a $7 Chipotle burrito back in 1921, that $7 would be nearly $105 in today's money. With high inflation being on everyone's minds and plastered across the news cycle, today we're going to cover 6 different ways that you can shield your money from inflation. If you're new here, my name is Courtney and this is my channel where I talk about all things investing and personal finance. If this video helps you, please consider hitting the like button and subscribe to the channel to see more content. So the first way to shield your money from inflation is real estate, and in particular, taking on real estate debt. Let me explain. If you took on a fixed mortgage, you're on the hook to pay the bank back a specific amount. If inflation rises over time, the dollars that you're indebted to the bank are now worth less because inflation decreased their value over time. At the same time, real estate is an appreciating asset, meaning that it's going to go up in value over the years. So the value of your home is going to be increasing at the same time that you're paying back the bank. So essentially you're paying for an increasingly valuable house with decreasingly valuable dollars, which definitely makes this an effective hedge against inflation. Now also note that real estate can be prone to boom and bust cycles, so there could be a lot of volatility over a period of time and your money's going to be locked into this property. So this definitely isn't for everyone. This leads us to our second way to avoid inflation, and that's REITs. A REIT stands for Real Estate Investment Trust and is basically a way that you can buy shares of income producing real estate just like you would buy a stock or an ETF. REITs can be an effective defense against inflation because typically with inflation, rents and home values rise, which makes REITs an increasingly powerful bet against inflation. REITs are a great way to invest in real estate without locking up all of your money on a specific property. And so definitely look into these more if you think they might be for you. The third major way to protect yourself against inflation is to invest in stocks, mutual funds, and ETFs. In inflationary times, the rising cost of raw materials can really hurt companies. However, oftentimes companies simply pass the rising cost of materials onto their customers so that they're able to still turn a profit. In fact, given historical returns, stocks do tend to beat inflation over the long term. For example, let's take the S&P 500. From 1926 to 2017, the annual rate of return for the S&P 500 was 10.22%. The average rate of inflation was only 2.89% for that same period. So putting your money in a fund that tracks something like the S&P 500 is probably going to be a pretty safe bet against inflation over the long term. The fourth way to protect your money from inflation over the long term is to invest in precious metals. Gold and silver have long been viewed as a hedge against inflation, as their value tends to climb when inflation is a fear. This is partly due to the thousands of years of history that these metals tend to have, and investors find comfort that the value in them will remain and tend to increase, even while the value of currencies like the dollar decline. Because of this, investors tend to pour their money into these metals like gold and silver, which increases their value even further. And one of the major downsides of investing in these precious metals is that they're physical objects, and so you are obligated to keep them safe. Imagine if you had a safe full of gold that was robbed while you were out of town. That would be absolutely devastating. To avoid this, you can buy funds that actually track the price of gold so that you don't have to physically own the object. So if gold is something that you're interested in, definitely take a look into some of these funds. The fifth way to protect yourself against inflation is to invest in TIPS. TIP stands for Treasury Inflation Protected Securities. These are essentially government issued bonds that rise with inflation to protect investors from a decline in the purchasing power of their money. If inflation does go up, TIPS adjust their price to maintain their real value. This can be a major benefit during inflation, but the major downside of TIPS is that they tend to have a lower interest rate than other bonds. So if inflation does not occur, you're making way less money on TIPS than if you were to invest in other bonds or stocks. The sixth and final way to protect yourself against inflation is to invest in commodities. Commodities Commodities are basically raw goods or products that are essentially the same regardless of who made them. For example, a barrel of oil is just a barrel of oil regardless of where it came from or who made it. Its value is set by what exactly it is. It's a barrel of oil. Because prices rise with inflation, commodity prices tend to rise with inflation. So if you invest in these physical products, their values will tend to go up as inflation rises. So those are 6 different ways that you can shield your money and investments from inflation. If you have any other suggestions on how to shield your money from inflation, please let me know in the comments below. I would love to hear from you. And like any investment, all of the investments that I mentioned here have their own risk associated with them. So definitely do your own research and decide what risk is right for you to take on. If you found this video useful, please hit that like button and subscribe to the channel if you want to see more content. Thank you all so much for watching. I hope you all are having a great day, and I'll see you in the next one. Bye.